Hey, everybody. Happy January the 12th. And just so you know, while people are rampant on here, I thought that I got up early, put on a social media post just as a reminder for anybody that hadn't thought about it or whatever. And the first comment I got was, Biden will not be the 46th president. And my response was, either way, we are here to help privately held businesses save money, make money, stay out of trouble, and have some fun in the process. So that's what we're here to do. Hopefully educate you, regardless of whether he takes the office on the 20th or not. These are the things that we know. And we also know these truths to be self-evident. And that is, most career politicians don't tell the entire truth. So we're going to go with what we know based on what has been posted, and then we'll let the chips fall where they may. So just as a reminder for everybody that's on here, we will post this later on the BGWCPA YouTube channel. And if you want to send us live Q&As, we will get to every one of those. Use the Q&A button, not the chat. And try to avoid the political statements on the Q&A. Or on the chat. There's just too much of that going around. Let's just stick to what we can control, our attitudes and our efforts. And part of the efforts are, hey, let's be educated and be prepared as possible. So Adam, without further ado, the mic is yours.
So I promised Gary that I wouldn't go on a political tirade at the very beginning, and I'm not. But I would be remiss in not sharing a funny meme that my wife shared with me this morning, which was, for everybody in 2016, that did not vote for Trump, you were all asking yourself, I wonder how bad it could get. It's only 4 years, maybe 8. 2021. Hey, could someone tell those people storming the Capitol building that there's a plague going on? So I thought that was pretty funny from a relative standpoint. That I know it's serious for people depending on their beliefs, but the one thing that I did want to say in terms of speaking truth relative to sugarcoating or glossing over stuff is that at the end of the day, if I right now, if I'm standing here as a citizen of the United States, I share all the same concerns around an ever increasing deficit, economic growth, all of that. And at the end of the day, as painful as it is, a budget's actually really simple. If it's balanced, you bring in and spend the same. If you're trying to reduce the deficit, which means you're trying to get out of debt, then you bring in more than you spend. What never works is let me bring in less and spend more. That seems like the old make it up on volume argument. So, and I just have to say, look, every single administration since Bill Clinton in the 90s and Newt Gingrich in the House has spent more than they brought in, period. Like, that's just a fact. So if I then spin around and I'm now Adam Boatsman, taxpayer, this tax proposal sucks. Now at the same time, and I am serious about that. Like it's a lot more in terms of what you potentially have to pay. And Matt's going to go through that in a second. I was also remiss in not welcoming Matt. To some of the people that haven't been on the webinar before, we're pleased that we added Matt to the team. He is my equal cohort here in all this crazy tax stuff. And just joined the BGW team in January from his company, Andersen, which is an amazing company that we're happy to have now part of the BGW umbrella. For anybody that was joining that knew Matt, welcome, and I look forward to getting to know you over the course of the next several years. So anyway, it's going to be hard as an individual taxpayer. So I think what's tough about all this is like, as an individual taxpayer, it's like, I agree with everything that Adam Boatsman, the U.S. citizen, said. I just want someone else to pay for it. I don't want to pay for it. But unfortunately, I don't know if that's really going to be the reality or not. So that's number one. I think number two is, as I was preparing for the webinar, I know we're going to go through the differences between what our tax rates are today, that really predominantly, and rightfully so, and I'm a big proponent of, were cuts that were made under the Trump administration and really targeted bringing a lot of parity for our businesses to be competitive on an international level. So, I think you've heard us say it before. It's like, this was not a middle class tax cut. It was targeted to business owners, and it helped business. It did. Like everybody that owned a business for the most part got a tax break, and likely did something positive with it. So I really liked it from that standpoint. But what I went back and I looked at is, all right, there was a time period where we actually did bring together a group of Democrats and Republicans to figure out how do we get out of this hole that we're in, which is taxes and spending and reducing the deficit. That was done under the Obama administration. If people remember their Wayback Machine, it was called the Simpson-Bowles Plan, which, Erskine Bowles, North Carolina, so North Carolina native, he was the Democratic side. Simpson was the Republican side. Universal bipartisan consensus from unelected officials. With elected officials, this plan went nowhere. But what the plan really advocated, when I went back and looked at it, is actually a lot of stuff that's sitting here in this Biden plan. And it was effectively, you don't see the budget side of the equation. I mean, all this is stupid if there's no budgetary constraints that are placed on it. But on the budget side of the equation, it said, hey, let's put a cap on government spending relative to GDP. That's probably a good idea. It said, hey, let's eliminate some tax loopholes and do something about the capital gains tax rate. Maybe not. It's just that their idea was there's probably going to have to be a tax increase, and there's also going to have to be budget reductions, which is how we're going to get out of this. Which is kind of how we open the call. Like, that's just basics of budgeting. And the last time that honestly happened was under the Clinton administration in 1993, which was a modest tax rate increase with some benefits to the lower and middle class that mostly hit high income earners, and then some budget reductions that happened. And during that period, the GDP went up by over 4% a year. So it's something to think about in the context of all this discussion that we're about to go through. Is that, look, I mean, we have done it before in terms of, modest rate increase, targeted cuts towards lower middle class. At the same time, that only works if combined with some other form of fiscal restraint and some belt tightening. It's the only way to get some compromise around here. The plan was already on the table. It's called the Simpson-Bowles Plan, and every elected official said, "Ooh, maybe the other guy can go for that, but I want to get reelected. I'm not going to tell people that I'm going to tax them more and spend less on them. Jeez." So that'd be telling them the truth of what it's going to take to get out of this mess. So anyway, I just, it goes without saying, like, as much as the rhetoric is that's out there, we try to be as objective as possible here regardless of politics. And it's a freaking math problem at the end of the day that solves the problem. So anyway, with that in mind, Matt, you mind sharing a little bit about what we're in store for here?
Sure. Yeah, I'm happy to. I think we need to take a snippet of this video just of what you were talking about, Adam, and send it to our representatives in DC. Just maybe a little bit of accounting education, basics. They can learn something. Gary, could you show the slide?
Here we go. Can you see that?
Yes, sir. So basically, with the Biden tax proposal, it's specifically targeting taxpayers that earn over $400,000. That seems to be kind of the breaking point where they're defining where they're going to try to raise the tax revenue from. So I broke it into three segments here. So we've got our individual proposals. We'll look at the changes to corporations and businesses, and then we'll also look at estate tax changes. The three big things that I'd like to show as a comparative are a change in the highest marginal rate for individuals. So the highest tax bracket that individuals are paying are going to revert back to what they were under the Obama administration. So it will increase from 37% to 39.6%. The next big change, and I think this is a pretty significant change, is the highest qualified dividend and capital gains tax rate, and this is for taxpayers earning over $1 million, is going to go from a 20% tax rate to being taxed at the 39.6%. And what this is making me think is that, it's something to pay attention to if you're looking to sell a business or, exit something, a large piece of real estate. This is something that we'd need to do some definite planning around. And then the other big one is the Social Security tax on wages is current for 2020 was $137,000. Your Social Security was taxed on your wages at 12.4%. And then once you went over that threshold, it was zero and you just paid Medicare tax. What this proposal includes is wages over 400,000, the Social Security kicks back in. So it's an additional 12.4% tax on wages. That's a pretty significant change. A few other things that will affect individual taxpayers. There has been some conversation around changing the deductibility of the 401k. There's a proposal out there to equalize the benefit for low-income taxpayers and high-income taxpayers by actually having a tax credit. I haven't seen anything relative to what has been proposed as a rate, but the deductibility of a 401k in exchange for a tax credit. Other pieces of the proposal for the individual is returning more to capping itemized tax deductions for individual taxpayers. Basically, the benefit that you can receive caps at 28%. So if you're in a higher marginal rate, you're actually going to see some reduction in your overall itemized deductions. And a few other ones for lower income taxpayers, there is a proposal for the increase in the child tax credit, basically expanding it from $2,000 to $3,000 per child under 17, and then $3,600 for children under the age of 6. And this is just as the economy is in the recovery period. Another significant change is the expansion of the child tax, the dependent care credit. So basically for daycare expenditures. Currently, your maximum qualified expenses are $3,000, and this will move that threshold up to $8,000 per dependent. Gary, could you scroll down just a bit for me? And another interesting one is bringing back the first-time home buyer tax credit for up to $15,000 for the first-time home buyer. And I think, again, the impetus of this is just to get people out there and start stimulating the overall economy. All right, for businesses, what I looked at was the corporate tax rate is currently at 21%. And I think going back to what Adam said, this makes us competitive on an international scale by having a much lower tax rate. What the Biden plan is actually proposing is increasing that from 21% to 28%. In addition to that, for taxpayers over 400,000, so if you're an S corp or a partnership or sole proprietor, when your income exceeds $400,000, the Trump tax deduction, the 20% small business tax deduction, will begin to phase out. And then another caveat is if your net profits are over $100 million, there will be a 15% book tax rate, basically on your net income. And if you can, the estate changes, I think two pretty significant ones. They're going to raise the estate tax exemption or lower the estate tax exemption. It's currently at 11.5 million per taxpayer, and they're proposing dropping that back down to the 2009 limit of 3.5 million. That is a pretty significant change, because anything over that will be taxed at the estate tax rate. So estate planning is going to become quite important. And the other one that is significant for anybody that's a beneficiary of an estate is they will eliminate the step up in basis on assets that are inherited. And basically, to translate that from accounting to just normal terms, is if you inherit a stock, let's say it's $1 million from your dad, and your father paid 100 grand for it, you've got a $900,000 gain. If you inherit it when he is deceased, your basis steps up to $1 million, which is what it was on the point that he passed away. So you eliminate that gain. Basically, under the Biden plan, what would be proposed is that your basis would be, what your father's basis was, and you would have to recognize a gain if you decided to dispose of that asset. Those are the key items that I've taken a look at, and I know Adam may want to expand on some of them. One of the other things that I was kind of curious about is, when would this most likely happen, and what is the probability? Currently, in my guess, I would expect to see, if there's going to be tax changes, it would be effective in 2022. If we look at when Trump was elected at the beginning of 2017, and when he went into the office at the beginning of 2017, it took him to the end of 2017 to pass his tax law changes that were effective in 2018. I see this as being something that will most likely pass in 2022. The probability of everything going through, I think, is thin, but I do believe that we're going to see a pretty significant tax increase coming.
Yeah, I would tend to agree. I mean, we've had a bunch of questions around, retroactive or prospective, and generally in our recent past, meaning the last 30 years or so, there's only been one retroactive punitive tax rate change, and that actually was under the Clinton administration. The other thing to consider too is that, generally tax rate increases are not passed during the recession. Or during a recession, or hopefully not during a global pandemic. So I could also see this not being layered in until at some point in the future, when it feels like there's generally an economic rebound. So a good way to think about that is, hey, if your interest rate went up, that's probably a good trigger that your tax rate is going to go up to at some point. The other thing that I would touch on is that if you look at these rates, if you could, that corporate rate that we're on the slide for now, that's that corporate rate is actually exactly what was in Simpson-Bowles. So Simpson-Bowles proposed to cut the old C Corp rate from 35% down to 28% to be more competitive. And Biden's saying, well, let's go with the Simpson-Bowles rate. They were proposing to have the highest marginal rate be the 39.6% that it is in this proposal. And they also proposed eliminating the capital gains tax rate. So that's why I said a lot of this stuff was actually straight out of Simpson-Bowles, as painful as it is. The only other thing that I would say speculatively on the estate tax is that, most people would view that, like, the estate tax itself is already a double tax in some respects, in the sense that I earn money, pay taxes on it, and then I'm having to pay taxes on it again if I have a taxable estate. Taxing the unrealized gains, is just that's just another form of the double taxation that they're talking about. So if I was to speculate, what could I see passing? Learn the exemption, not giving a step up in basis, but not forcing people to have to liquidate assets, because how would you really differentiate between, how would you really differentiate between somebody who inherited land versus somebody who inherited Microsoft stock? Microsoft stock has access to liquidity. The guy that has the land doesn't. So you're kind of forcing someone to sell something subject to terms and conditions. But all that said, I know we've always talked about, hey, at some point, whether it's now or whether it's 2025, when this estate tax was due to claw back anyway, time to take advantage of the higher exemption level. Well, I think that just got accelerated. I mean, if you haven't fully utilized your full exemption, now's the time really to be thinking there, other than the emotional aspect of giving up control of something, there's no reason to delay this any longer. It's time to potentially do something if you haven't done it before.
So here's a question, and just as a reminder to the 74 of you who are on this thing so far, and I think we have some people that are wanting to get CPE credit, so good move. But anyway, the question was, okay, so Social Security taxes stop being collected after 130,000 right now, I think. Under this plan right here, will they continue to be collected up until 24 to 400,000, or do they just reactivate again after 400,000?
It's my interpretation that it reactivates after 400,000. So there will be a gap between the one, I think the new thresholds like 142, from 142 to 400 would not have it, and then after 400 Social Security would be back on.
That's correct.
All right. Any other questions? We got another person that's jumped on. Speak now or don't forever hold your peace, because we'll be back here actually on Thursday morning to talk about PPP without Jack Santaniello, because he's going to be doing something with the FBI. We can't talk about it any more than that. So questions. First of all, while anybody's trying to think of whatever question that they might have on this thing, I may have scared them off by saying, hey, cut off the political rhetoric. I am kind of serious about that. But I do want to say, seriously, it is really good to have two really great strategists like both Adam and Matt on the phone and on this webinar at the same time. But it's also great having them both at BGW. Sure makes my job a lot more fun and a lot easier. And we've got a whole bunch of smart people, but these guys love going into strategy, and we need that. So business owners out there, take advantage of brain trusts like this that are out there. You don't have to go this thing alone. So anyway, so go ahead, Adam.
I think probably the other thing that I'd be contemplating too is that, for anybody, again, this is all still really speculative, and you would think that it would appear in the pricing accordingly. But at some point, when you go to sell your business, what tax rate you're going to pay has to factor into the calculation of how much you're going to ask for, because it ultimately affects your net proceeds. It's also going to affect transaction structure. So, for example, if I was to sell at the end of the year, it could be that even if I've got a seller note, I like to have it all taxed now under today's rate. Or alternatively, if I know what the tax rates are going to be in the future because something like this is passed and given an effective date, maybe I enter into an installment agreement, and I'm more open to doing seller financing, because if I can keep my income below $1 million on that note, then I have the possibility of paying it at a 20% rate instead of a 39.6% rate. So, all these are going to be factors when it comes to business sales. For Hayden, tax year, we think it's the earliest it probably would take effect speculatively is 2022. I can't imagine they're going to do something retroactively in 2021, and there is precedent for it, but it was a long time ago, and it wasn't this dramatic, and there was not a zombie apocalypse going on, nor a recession. So it'd be hard to say, in the unemployment at the level it is, so it'd be hard to say that this is really going to happen in 2021. 2022 possibly, 2023 starting to feel more likely. So that's what we're thinking in terms of the year.
So any other questions or thoughts because I know we also have some CPAs out there who may want to, you know, one up Matt and Adam a little bit. I don't know. Hey, David, you out there? So I didn't see him on the list. Oh, here we go. Awesome. Here we've got a great, a brave person. Mark, thanks for doing this. Oh, you're 2 days early, man. So here's the question. With regards to PPP, if you guys want to jump the shark a little bit, I'll do it. But he says, I could wait until the next webcast. But wanted to know, if you bought a business in mid-November 2019, how would you calculate your year-over-year sales drop? Only 6 weeks of sales in Q4 2019. Would it be prorated? You want to answer that, or you want to make them wait?
Well, no, it's a good question. I think that, you know, we addressed in the last webinar is that, you know, we haven't had any cases where we've had somebody try to take kind of a successor position when it was a brand new EIN. So if you bought, you know, stock, retain the EIN, or bought membership interest, retain the EIN, you probably got a case that you had the history before too. If you didn't, although that's still a legitimate argument that, hey, I really bought a continuing operation, you're not under the same EIN. So it's got some hair on it from that perspective, because you don't really have any history under your EIN when they go to match stuff up. But all that said, the guidance is that you either use Q4 of 2019, or you can use Q1 of 2020 if you hadn't been established. So that's what I would look to.
All right. Well, Mark, good thing that you jumped on today. You got your answer 2 days early. Hopefully that was helpful. Any other questions out there? Okay, so Mark's already kind of opened up the door. If somebody has a burning PPP question that they want to jump on here, go for it. Okay. Oh boy, we may have opened up. Okay, good. All right, Mark. Yeah, our pleasure. Thanks for joining us today. Any other questions out there, folks? Any other comments from you guys before we sign off, in case we don't have any other questions?
I think the only thing that I would add is I did see some information in regards to real estate investors. So it may be something to pay attention to as well. I've seen some, basically in Biden's proposal, it did say that they would end some of the loopholes. So there is some speculation out there that they'll close some of the loopholes on real estate investors as well. The big ones that I was able to find, which are ones that I enjoy, is cost segregation studies and limitations on passive deductions. So just putting it out there that they're also looking at real estate as well.
So a couple things have come through on the chat. So Heather has asked, where can I get a copy of this information sheet? And my gut is we'll probably put it up on our website. If you're on our mailing list, we'll ask for Rachel or Jamie to see if we can get that out as a recap, as a PDF to everybody. But I think we should be able to put that up on our website. And then Hayden, okay, I think you may have already answered this, but can you repeat again what tax year you think this will take effect realistically?
As Matt pointed out in the beginning, you know, earliest is probably 2022. So 2022 or 2023.
Agreed.
This has been a very respectful crowd today. The chat, maybe I have a feeling that that Jack sent in yellow kind of pokes the bear a little bit. And I don't know. I thought it was always Adam, but I think it may be Jack, because these guys they have not been harassing us too much on the chat. They've been pretty respectful. Dwayne says, thanks, Adam. Much appreciated. Dwayne, thanks for sending us that note. I got another question that's come in. Okay, yep. Heather, we just answered it. So we will get a copy of this as a PDF out and either hung up on our website, probably look within 24 hours, I would imagine. And then we will, if you are on our web or on our email broadcasts, you'll be getting it. And if you're not on our email list, just send me an email at gfrey@trustbgw.com, gfrey@trustbgw.com, and we'll get you added to that list. Just as a reminder also, we do have a once a week PPP webinar. I would have never imagined when we started these on whatever it was, the 24th, I think, of March, when we had our first one, or maybe even earlier, that we'd still be doing these, but the need is still out there. And we will continue probably on every Thursday at 11 o'clock to have some sort of live Q&A for businesses that are still trying to navigate this stuff. There's plenty of information that we can share with you guys. And just what we've found during this period of time is that business owners are being awash with all kinds of information and misinformation, quite frankly, and don't know where to turn. And they're afraid to pick up the phone because they may get billed by like an attorney from their CPA. You will not be doing that with us if you're a client. But nonetheless, we are here to serve the business community. We love serving you guys. And so got another question that has come in here. That one has been answered. That was my fault. Anything else before we sign off and return again on Thursday at 11 o'clock on PPP?
No, other than, again, it's just keep in mind, it's a basic math problem. At some point, there's going to have to be some form of shared pain and sacrifice. We're just debating when. And the only data we got is tax increase, modest spending, 4.7 GDP growth. I don't like it any more than anybody else, but that's what's happened in the past.
Matt, anything else as you're looking back over the bay in Seattle with that virtual background behind you?
I would just say, I'm with Adam. I think it's inevitable. It's coming. I think what we need to do is, we'll keep our eyes and ears and see what's happening and keep everybody up to date. The goal is, at least for me as an advisor, is to minimize what the clients are paying and working with the people that I work with to keep it as minimal as possible. But within, the guidelines of the code, and rates will be going up. So I think to be prepared for an increase is inevitable.
All right, just as a reminder, we will put this broadcast up on the BGW CPA YouTube channel. That will probably be up later this afternoon. So come back, and if you have questions, feel free to email me, and we will be back live again at 11 a.m. Thursday morning, Lord willing, and with the amazing Adam Boatsman. And hey, maybe we can even let Matt back on here. That'd be kind of fun.
Right.
If everybody takes their gloves off, start hitting the new guy.
That's actually kind of a good idea, since Jack is going to be doing FBI stuff or whatever he's doing. I've got some theories about it, but I think that might be good if we can get you free. Anyway, thank you everybody for taking time out of your day to spend with us. Hopefully this has been beneficial and helpful. We appreciate you. You guys have a wonderful day. Go get them.
All right. Thanks, Gary.
Thanks, guys.
All right. Bye.
Bye.